Hi everyone, welcome back today. Today we're talking about something that's called some people off guard, life insurance premium increases. We've had a lot of people get in touch recently after receiving their renewal notices. The most common thing we're hearing is, why am my premium increasing when nothing's changed? So in this video, we'll break it all down, what's going on behind the scenes, what you can do about it, and how to figure out whether your policy still fits your requirements. Russell, you've been chatting with a lot of people recently. What sort of trends are you seeing?
Yeah, thanks, Megan. Looking forward to doing this session today. I think one of the things you've definitely been seeing is that, despite there's been some interest rates cut here in Australia, there's still a lot of pressure on those household budgets. What we're starting to see is that, customers are definitely having a closer look at their life insurance premiums, and a lot of existing clients or, clients even looking for insurance for the very first time are very focused on the family budget and the value it presents. So we've got, really two types of people looking for better value. It's either those clients who might already be policy holders, or clients are looking to get into the market for the very first time and really focusing on that family budget and how they can really start to or continue to afford their policies.
Thanks, Russell. So here's a quick look at what we'll cover off today. So on the agenda, we have why are premiums going up, what to do if your premium has changed, real client stories, and then we'll take you through some frequently asked questions around the topic. Before we carry on, I just want to remind you that the information that we're sharing today is general in nature. It doesn't take into account your personal circumstances, financial situation, or specific requirements. We always recommend getting personal advice before making any decisions about your insurance requirements. Perfect. Thanks, Russell. All right, so let's jump into the first topic. What's actually behind these premium increases?
A couple of things that are, I suppose, still happening in the market at the moment. So you're still finding insurers having higher than claims expectations. So what does that really mean? It means that, when an insurer looks to price their portfolio or their insurance product, what they do is they've got a number of different assumptions, normally based on historical claims. Then they look to see, okay, how should I go ahead and price that contract or that cover time within that contract? And what we're still seeing is that claims are still persisting and still continuing to increase. So this is really resulting in higher claims expectations and actual claims being higher than expected. So what's having to happen is that we're starting to see insurers putting up prices. So total and permanent disablement cover, prices are still increasing in that area. We're still seeing a lot of income protection pricing increases, especially on those existing client portfolios. So those are the two that we're continuing to see moving on price. We're also starting to see insurers really trying to make products more sustainable in themselves. So back, many years ago, there was a lot of cross substitution. So they might have had one policy or one product type substitute another cover type or across that portfolio. But now they're looking to also have each cover type be more sustainable within that product series versus that cross-subsidization. So as a result, we're seeing increases across some of the group insurers. Repricing has been felt. Now, some of those pricing adjustments, could be fairly small and could be greater depending on your occupation, your age, and the cover type. And also across some of the retail life insurers, here again, it's very dependent on the cover type, the age of the policy, and sometimes what particular feature you might have selected in your particular policy setup. So one of the things that we're starting to see now is, let's say you had a benefit period to age 65 on your income protection policy. So that might be experiencing a price increase, whereas a 2-year benefit period might only be having a moderate price increase or a very low price increase. So it does also depend on what you may have selected at that time. Now, be mindful that these pricing increases wouldn't be targeted at an individual. It's more at a product series level or a product or a cover type within the product series. So that's always something to bear in mind. And one of the other things we're starting to see a lot of, so not only are we seeing a lot of the existing portfolios, getting price increases, we're actually starting to see a big increase in introductory offers. So, 2-3 years ago, it was very rare to receive an introductory offer to a new life insurance policy. But now we see a lot of introductory offers across a number of the different brands. And there's two categories of those. There's the introductory offer just for being a new client of said brand. And there's also another one that's also relatively new on the scene, been around for a couple of years now, is the health and wellness programs. So some of the insurers are really focusing on trying to improve the pool of clients that they are looking to onboard within their portfolios, and incentivizing those healthy lives to come on board by offering discounts to that particular client. So there's a couple of different health and wellness programs out there. Each one has a slightly different structure and how they operate, but their fundamental drive is to try and reward those healthy lives for coming on board within the portfolio, and then some again actually continue to motivate that customer to remain being healthy, such as Vitality, where there's an engagement element of that health and wellness program, which does also flex a health and wellness discount and also provide some other incentives to help your engagement with that program.
Great. So if someone does get that renewal letter that the price has gone up, what should they do next?
So what a client should do when they get their renewal notice, the very first thing that I would always be encouraging a client to have a look at is, firstly, let's just do a quick situation check-in, right? Let's just have a quick check-in and think through what are the different types of cover that I need at the moment. So, what has changed in the last 12 months? What do we foresee going forward? So firstly, I'd like to just go ahead and do a quick check-in on that. The next thing I'd like to go ahead and do is think about our cover levels of cover. Is $1 million worth of cover or $500,000, 750,000? What does that look like, and what does that look like going into the future? And then I want to think about, if I've got income protection, what's my waiting period? What's my benefit period? And that monthly benefit. Here again, I want to just have a quick look at those options. So that's the next step. So firstly, it's cover types, then it's our sums insured. And then I'll really want to look to see, do I have any bells and whistles? Any of those policy options that I might want to consider removing now, or I might want to reassess how much they cost. So a thing like claims indexation on your income protection policy is very valuable to you if you're young. However, as you get older and closer to retirement, the benefit might not be as valuable because the indexation is not going to be in place for that many years if you have a long-term claim. So those types of things are things that you might want to look at adjusting, and or some of those other paid options. So once you've got a really good idea of what that looks like, I would always, kind of encourage a client to, reach out to their existing insurer and see what they can do to, start that rationalization process, right? Okay, if we do make these adjustments, what does that look like? Okay, fantastic. So now you've got an idea of what you would like and what your new situation and how you want to rationalize that policy, right? They'll give you a new price, and then what I would then suggest to do is to go and have a quick look around and make sure that still is good value for money, right? Because as we're starting to see, a lot of the insurers are pricing up their existing portfolios, right? Because what's happened is that this client has now been on the books for a number of years, potentially. And what's happened is that their client is further and further away from when they were last underwritten, when they were last assessed. So what we can see is the lazy tax coming in, and we're not going ahead and then shopping around. So what I would do next is do a quick shop around. Let's see if we can try and compare apples to apples. Not going to always be exactly the case, but quite often you can get to the apples versus apples situation, and then do an assessment to see, okay, so there are some risks moving from my existing insurer across to a new insurer, which we won't cover off in this session, but I want to assess those risks and understand that I'm resetting my duty of reasonable care, moving on to this new product. But I think what, at some point in time, you've got to realize that, I still need to be able to afford this policy. And if you continue to comply with your duty of reasonable care, those risks can be managed. So it's really important for you to do that shopping around and having a look to see what's the value being offered, if we were to go and have a look at some other providers. So that would be what I would look for. And as I mentioned a little bit earlier, we are seeing a lot of those introductory discounts, which we might cover off a little bit later. But if you are looking to take up a new policy, understand a little bit more about that introductory offer. Is it a one-year offer? Is it an offer that tapers off over time? Or we are also seeing other offers in those health and wellness programs where the discount actually stays on the policy for the life of the policy. So really important for you to do that shopping around exercise because you can often find some very good value for money. But here again, just be mindful of, the risks in moving from one insurer to another. But, there are definitely some sharp offers out there at the moment.
Great. Thanks, Russell. So next, I think we should run through a couple of real examples of how this has played out for some of our clients recently.
Fantastic. And so just a couple of examples that came across over the last month or so. So we had a customer reach out to us. They're currently paying $190 per fortnight. This was a 53-year-old male, currently insured for $1 million worth of life insurance, and they're currently paying $190 per fortnight. Now, they actually signed up for this policy direct with the insurer. So it was a direct policy, not a policy that they would have got through a financial advisor or an intermediary. And they basically reached out to us, and we were able to provide equivalent quotes, and that was coming in at $113 per month. So as you can see, this can really have a major impact on a client. So with the potential savings there of around $2,000 per year for this particular scenario. And the client was very happy with that option that was presented. The next case study was a 60-year-old male looking at $500,000 worth of life insurance here again, just pure life insurance, currently paying $314 a month on a variable age step premium structure. And after review, there was an alternative offering here again, the same types of cover, just life insurance, also on a variable age stepped policy. And we managed to get a premium in place for $186.39 per month, which is a fantastic savings here again. That was around $1,500 per year. And it was also fantastic to see that, there was a lot of constraints here on the budget. And we really helped that family and helped them assist with regards to their family budget and putting that life insurance affordability and reducing those costs to ensure that they are able to maintain some coverage, which is really important. In this third scenario, we had a 50-year-old male who was here again looking to undertake a reassessment of their life insurance requirements. What was interesting here with this particular client is their policy hadn't been in place for all that long. However, they did actually have a medical loading on their policy. And one of the parts of undertaking a review for a customer is to see, can we get that loading reviewed or removed? And we're able to go ahead and secure a new policy for this customer because they had a different view on the loading and the medical history of this particular customer, and they were looking at a $1,560 per year premium versus the proposed renewal of $3,085 per year. So that's another $1,500 a year savings. So we thought we'd just kind of highlight these three different case studies that we've recently had, and we thought we'd highlight the benefits of shopping around and just having a little bit of a look around and a sanity check when you get that renewal notice in from the life insurer, whether it's by email or in the mail. It's always good just to reassess your situation, understand the types and levels of cover that you want, and then do yourself a favor and do a quick shop around just to make sure you're getting some good value, and always just be mindful of those downside risks of moving from one insurer to another. Not only do you have the resetting of your duty of reasonable care, but there could be some losses from policy A and moving to policy B. And here again, you might also have some gains, moving from policy A to policy B. So really important for you to consider those as well. But here's 3 scenarios that I thought would be of interest to our audience today.
Yeah, thanks, Russell. That was really interesting. I really think these examples go to show how much of a difference it can make if you do a proper review of your cover at an appropriate time. All right, so moving on, let's go through some of the questions we're getting most often right now. We've touched on this already, but just to summarize, what are the main drivers behind premium increases right now?
Yeah, so still the main premium increases are still higher than expected claims experiences, and it's still primarily around those total and permanent disablement insurance and those income protection policies, and especially those ones with the longer benefit periods. So income protection more broadly, but we are seeing higher increases for those ones that might have to age 65 or to age 70 benefit periods. Is definitely the ones that are being impacted more than the 2-year benefit period options, for example.
Great. And could you tell us about the discounts that are available out there that people can access if they're applying for cover now?
Yeah, great question. So there's, we work with up to 9 different insurers. So I won't go through all of them, but I'll pick a couple that we've got here at the moment. So one of the particular brands is offering a 10% introductory discount in year 1 and a 5% discount in year 2. Okay. Now, the other particular brand that I'll mention at the moment is a kind of a tiered discount, a tiered introductory discount. And this is for life insurance policies, life and TB policies. And they've got a tiered discount. So it starts at 21% in year 1 and tiers down over a number of different years. So it's over a 10-year period that looks to tier down. And what that means is that discount's slowly dropping off each year. So you're losing basically 3% each year over that period of time. So it's not over 10 years. I believe the introductory discount's over 7 years and it reduces by 3% each year. The next one is those health and wellness programs. So here again, each one of them works slightly differently, but for a particular, just one of the ones that we have at the moment. So if your BMI is within their healthy range, they will offer you a 7.5% ongoing discount. Also here again on your lump sum covers, not income protection. So just be mindful of that as well. That is another example of a health and wellness program that's currently available on the market and does provide a benefit to you if you are within that healthy BMI range at the time you apply for the policy.
Great. And just touching on the health and wellness discounts, do you have to join a program or meet certain goals to take part in the health and wellness discount?
So there's a couple of different arrangements with these health and wellness programs. So the first one, I suppose, on the market was AIA Vitality in the Australian market, originally launched in South Africa. It's a fairly global offering now. But that health and wellness program is very mature in a sense because it has a introductory offer. So if you join the Vitality program and you have a healthy BMI, they will offer you a certain discount. If you don't have a healthy BMI, that discount's not as high. And then every year, what they're looking to do is to get you to increase your Vitality status through points. So that's through knowing your health or improving your health. And that gets you points each year. And then based on your Vitality status at the end of the year, that will then look to potentially provide you an increased discount or reduced discount depending on your vitality status. So if you're, for example, platinum, you could look to see your discount increase on renewal. However, if you didn't engage with the program, or you remained at bronze status, for example, then your discount may reduce on renewal. So that's a program where there's an incentive, to join, and an ongoing incentive to engage with the program. However, some of the other programs are a little bit more simpler than that. And all they do is they say, well, hey, if you have this healthy BMI currently, what we'll then look to do is just provide you with that discount, in perpetuity. So there's no re-engagement, if you want to call it that. And then there's another, a discount program that's offered by one of the providers where you start at a 10% discount. And what happens every year, you lose 1% of your discount. However, every second year, they'll send you a form to complete. And if you engage and you qualify with that particular offering, what will happen is they'll bump your discount back up to 10% again. So that's another, I suppose, model that's currently in place. So I think we'll continue to see these evolve. I think it's a great incentive for healthy customers to engage with insurers, and also an incentive to maintain one's health, because as we know, typically speaking, if we've got healthy population, the insurers have better claim statistics. So I think these programs are here to stay for the long term.
Great, thanks. And then I think another question we get quite frequently is, what is underwriting?
Yeah, fantastic. So underwriting is it's a process where where an insurer or an underwriter at an insurer assesses your medical history, your pastimes, and I suppose your insurability around how they want to price risks, right? So what they're doing is they're assessing you as an individual compared to their rule set and their underwriting guidelines, and going, can we offer, Russell or this particular person insurance based on our rules and our guidelines, and are we in a position to offer them cover? So it's very much an assessment of your health, your job, your lifestyle, and will also be your medical history will also come into assessment. And here again, the goal is about understanding the assessment of the risks that you present, and then also seeing if they need to make any adjustments to that. So let's say, for example, you have a particular medical condition, they may need to look to increase the premium to adjust for that medical condition, or exclude a particular condition that you might have had recently. So it really depends. And if your condition is quite severe, then they might say, look, unfortunately, we might have to decline your cover because we're not able to insure people with your type of risk profile. So it's really about them understanding the risk profile that you present and seeing if they can offer cover, and if they can, on what terms they can offer cover.
Great. And then I think a common concern that a lot of people also have is, will I have to get a blood test if I apply for a policy?
Yeah, great question. So typically speaking, it's relatively rare for an insurer to ask for a blood test. And I'll tell you why. So if you look here, I've got in front of me one of the mandatory medicals for a particular insurer in front of me. So this particular insurer says, look, if you're applying for up to $2.5 million worth of cover and you're under the age of 45, you don't need to do any mandatory blood tests or any mandatory medicals at all. Okay, so if I'm below 50, that's at 2 million. If I'm below 55, it's 1.5 million. If I'm below 60, it's $1 million. And if I'm over 61, it's $500,000 worth of cover. So what that means is that if you were a standard life and you were to apply for a policy, you wouldn't need to do any blood tests at all. Okay. However, what we do see is when you get over those sums insured, then what will typically happen is they'll ask for a mini check and a blood test, right? So that's typically done by a mobile nurse or paid for by the insurer. But that's when you're starting to get to those higher sums insured. So, getting over the $2.5 million up to $5 million for a 45, somebody who's below 45. So as you can imagine, you've got to be looking for quite a big, high level of cover before that applies. So that's as far as the blood tests go. The other time they may request a blood test is they may need an updated reading of a particular medical condition that you might have. So let's say, for example, you have high cholesterol, or you might have diabetes, but you haven't had a recent HbA1c, or you haven't had a recent cholesterol reading. You might not have been to the doctor for 12 months. In those sort of circumstances, they may also ask for a repeat of those tests just to get a more current, up-to-date reading. But typically speaking, it's not a lot of blood tests that get requested. I would say the vast majority of applicants don't have any blood tests requested. And the other method that they may also look to do, as opposed to going for a blood test or a quick check, which is just a height and weight check, and a urine test. So the other one is where they might write to your doctor to get a better understanding of your particular medical history. So quite often they won't go for the blood test approach. They might say, write off to the doctor and say, look, could you please tell me about, XYZ condition for this particular client? We'd just like to get a better understanding, and they'll ask the doctor to complete a bit of a questionnaire, and then that'll be sent through sent through to the insurer, and then they'll be able to make an assessment as part of their underwriting review.
Perfect. Thanks, Russell. And our last question for today is it cheaper to go with a broker or direct to an insurer?
I think, for the most part, it's more affordable to typically go with a broker or an intermediary. A couple of reasons. Firstly, typically brokers and intermediaries or financial advisors are paid for by the insurer. Obviously, you need to check with each broker or intermediary beforehand, but typically speaking, they're paid a brokerage, so there's no additional cost to you. And what you also find is their policies that they're looking to offer are fully underwritten retail contracts, typically speaking. So normally what that means is that there's going to be more questions and a little bit more detailed underwriting, which then compresses your price and reduces the price because they know more about you, right? However, if you went direct to an insurer directly, typically speaking, the prices are higher and there are less underwriting questions and less underwriting at inception. So it's called partial underwriting or light underwriting or limited underwriting. And then they'll do the, I suppose, more detailed underwriting at claim time. But that's typically speaking why your direct policies are more expensive versus ones that are sourced through a broker or through an intermediary. And they also have access to 9 different brands, or 10 or 5 or 3 or 2. You here again ask them and how many they've got access to versus a single brand offering by a insurer. Often they'll only have one pricing available based on the brands that they are or the brand that they represent. Here again, that could lead to opportunities where the brands might be pricing better towards a particular risk profile versus just that one offering.
That was awesome. Thanks, Russell. Thank you for these insights regarding pricing. Hopefully this helped explain what's going on with the life insurance pricing and gave you a bit of clarity around what you can actually do if your premiums go up. Remember, you don't have to figure it out all on your own. If you want to review your policy or see what other options are out there, feel free to get in touch with us. You can reach out for a policy review or subscribe for more straightforward insurance tips. Thanks for watching, and we'll see you in the next one.
Thanks, Megan. Great session.